Hello my fellow investors and welcome to Invest Like a Guru and to a quick weekly overview, a bit of what happened last week and what we will have a look at this week. Now last week was a bit of a mess on the markets. It was primarily controlled by interest rates and inflation, and it seems like the inflation is pushing higher, which of course is dragging the interest rates up as well, and that is kind of what is really facilitating this sector rotation that we are seeing right now away from some of the smaller stocks. One place you especially can see that is, for instance, in the RK ETF that has specialized in small, a bit illiquid, very speculative, disrupting companies. And we have seen a drop here since last February, and then till now, in 11 months, it is down 50%. And it's not that they're not still doing a good job. It's simply just that when the interest rate is going up, many of these small companies will have a harder time. And with higher inflation comes higher interest rate. Now that is kind of the picture we have heard from the Fed so far. Now the other day we had John Williams coming out, which was the New York Fed president. He came out saying that he expects the inflation to drop to around 2.5% this year from the current 7%. Now, to be honest, I have a hard time seeing that. Now, I'm no fortune teller, so he might be right. We can see that the energy prices are still pushing upwards. We can see that China might be closing something down again, leading to some sort of a supply crisis, some sort of crunch again there. And basically we are seeing higher wages. We have seen a lot of vacant jobs in United States. And actually John Williams is addressing this, saying that he is expecting the unemployment rate to go down to 3.5%, which is way below the 4.5% to 5% that Fed normally say is kind of the limit as to where they start to hike the interest rate. Now, even though he went out saying that, John Williams, looking at the interest rates here, we can see down from 2-year interest rates and up to 30-year, we can see here, let's just have a daily view, that on Friday they pretty much all went up. So it was not really anything the market took into account here. And an interesting thing to look at here when we are looking at the weekly chart is what is actually happening in the interest rate market. Because if we're looking back to May last year, around here, end of May, we can see that the 20 and 30-year interest rates are pretty much the same. They have just gone a bit down and then upwards. The reason why they've gone upwards here the last weeks in December and now in January is primarily the nervousness in the market. People are selling off some stocks, buying up some long-term bonds to make sure what they're getting in interest rates. So since May last year, these interest rates have pretty much just gone sideways. If we're taking a look at, for instance, the 1-year rate, again, since the end of May down here, that has gone from basically 0.05 and then up to around 0.5%. That is a hike of 800-900%. And that is simply because people are expecting rate hikes from the Fed. We can see the same in the 2-year interest yield. We can see it in the 3-year. We can see it in the 5-year. 7-year, and then at 10-year it is starting to leveling a bit out, and that is basically because 10, 20 and 30 years are the interest rates or the bonds people are going to when they are nervous about the market. So there is that here. Now overall, looking at the market, if we are taking a look at some of the larger indices over here, we can have a look at the US indices, which showing us the Nasdaq here. It has not been a nice start of the year here on Nasdaq. Luckily, our models have rotated out of tech, so we are not as heavily hit here. But looking at the performance so far, we are down just shy of 5% in the Nasdaq. And looking at the S&P 500, that shows us something like, let's just have a look here, 2.3%. So that is kind of the benchmark we should be looking at. There is also the ETF that we normally use as a benchmark due to the volatility profile that fits our models quite well. The volatility here in the AOA, as it is called, the iShares Core Aggressive Allocation, that has shown somewhat of a less drop, down 1.3%, something like that. So that is in the area of these 1.3 to just below 5% that we should have a look at our normal models, our ETF and stock models, to see that how they have behaved. Remember that investing in these models, we are not necessarily looking to never lose money. We can have drawdowns, and we are in drawdowns a lot of times during the year. We are simply aiming to beat the market. So let's have a look at the models here. We have the 3 stock models of weekly, monthly and quarterly momentum, and we have the 2 ETF strategies, the ETF strategy and the ultimate dual momentum. If you have seen our last videos, we have developed this ultimate dual momentum from the original dual momentum, trying to enhance it a bit. So let's start from the top here and look at the weekly momentum. And up here we see that the year-to-date returns is down 1.6%. Now, if you're subscribing to this, and remember you can always try it out for free for 30 days. If you have subscribed to this, you have seen that we went risk off just a day or two, a week ago or so, and then we went risk on pretty much right away. And that is how these models sometimes flick back and forth. The good thing is that when it goes to risk off and stays there, that is normally in really nervous and volatile times, and then it's a good time to be in these bond ETF that we are rotating into. So year-to-date return this year around 1.6%, and you can see we are keeping the drawdown from the top here at end November. We are still hovering down here in the area of around 12-13% from there. But let's see if the market shouldn't turn around here and give us a bit of profits during January and February. Monthly momentum is down 2.24% here. Again, you can see we are running around in the same drawdown area as normal, and we are somewhere in the middle between the S&P 500 and the Nasdaq drawdown here, the Nasdaq being down almost 5%, and you can see that is the reason why we are not down 5% is that we have rotated out, or the model has dictated that we rotate out of tech stocks, which seems to be a good idea as of right now. Not that we are not in any tech stocks, we are just in less tech stocks. The quarterly momentum is down just about the same here, minus 2.6%. And yeah, I am looking to put a bit more of my own money into these models that I invest in, simply to try and catch this drawdown in the model. I've talked about this before. I don't fancy going in buying in the drawdowns in single stocks, but when we have a good and well-tested models over a couple of decades, and I can see what the max drawdown usually is, then I have no problem putting more money into the models when they are in one of their larger drawdowns. So that is the 3 stock models, and then we have the 2 ETF strategies, and one of them here, the first one is the one we have been running live the longest. That is down 3.4%, and I know that should be the more conservative model, but one of the reasons why it is down 3.4% is that it has as far as I can recall right now, a triple leveraged Nasdaq position in there, an ETF, which of course is giving some drawdowns. But as you can see, it is a lot less volatile here. Only with drawdowns around 7.5%, and right now we are down at 3.65% from the top, so that is definitely not a catastrophe here. Then we have the last model, the ultimate dual momentum. That is the latest in our test series. We are coming up with some more this week. But right now you cannot really, the numbers here are not really stated because we only have very, very little data on it. But year to date, it is down 4.2%. Don't mind the CAGR at minus 65%. That is simply because we only have a couple of weeks data, so we cannot really rely on that. All right, that was the overview of the markets and the models. I hope it gave you a bit of inspiration. And as always, remember that you can test us out for free for 30 days. And after that, you can decide if you think the product is worth the subscription fee. That's all for now. Take care of yourself and your money out there, and I'll talk to you again shortly. Bye for now.